Mr. Rajan is working in the infotech considering the following particulars. Annual salary is 30 lakhs. Total working days in 2 years is 300 days. 1 year 700 days. Leave allowed in the as per the company's policy 10 days. Leave utilized by the Rajan is 8 days, 2 days remaining. Unutilized leaves are settled by the way of payment accordingly. Carry forward such leaves to be subsequent periods not allowed. With the total employee benefit expense of infotech. So 30 lakhs is payment. So 300 days he worked 10 days. So total is 300 per day. How much salary you so to have is 10,000 per day. So 2 days from 20,000. So total expenses. Rajan is entitled to salary of 30 lakhs 300 days. As per day salary is 10,000 per day. As on Rajan is allowed to 8 of 10 days in the company. According to utilize 2 days and the line of the company policy. Unutilized leave should be added to the total expenses. So 30 lakhs 20,000. Non-vested accounting benefits. Mr. Naranjan is working in the infotech considering the following articles. Annual salary 30 lakhs per year. Number of working days during 300 days. Leave allowed 10 days. Leave taken 7 days and 13 days he taken. So unutilized 3 days and carry forward next year. And so nil. So based on the past experience, the report seeing the mission was away in the unutilized leave 3 days. Employee benefit expenses such every year and start the leave will be and the keys are placed with you. And in the month of 14 treatment proposed by the following important to come to the first 30 lakhs 20,000 just added the version 30 lakhs. So salary 30 allowed leave 7 so 273 and expenses proposed to be recognized in 30 lakhs. Based on the evaluation of both sides working for 6 days more in compared to since is working more is compared to expenditure to money should be more as compared to the same for the same expense 30 lakhs again this would be violation of the upper concept expenditure the 30 lakhs 30,000 so number of working days are 293. So how much you want 293 3 days you work extra 3 days 3 working days you need to be paid 7 to be paid. So 30,000. Second thing is 387 people. Actually, what is his income is 2 lakhs. So such a employee benefit expense 30 lakhs to bank account 30 lakhs. Provision to living account 30,000. Employee benefit expenses 2,000. Leave provision and cash 30,000 to the bank 30 lakhs. Illustration 3 non-vested accumulated benefit. Assume that our information is based on the past experience in particular touching but it's now original available the place leave of 2 days. Subsequently hence average avail action 3 days above for 1 days. Complete expenses at economies so 2 days and 3 days. So 30 lakhs plus 3 days plus 2 days. Expenses respective change in the accounting estimate. So employee benefit expense 30 lakhs to back 30 lakhs to employee benefit expenses to 30 lakhs. As in the employees entitled to 30 casual leaves and 10 sick leaves can be carried forward to next year. 10 sick leaves out of which 10 sick leaves may be carried forward to India match the advances and use entire highlight of 5 days as by employee as usual. Out of 10 leaves out of 2 6 leaves may be carried forward responsibility. Average annual 5 days per employee of the casual leaves, 1 day per employee sick leave. On the average, it is found that the number of such employees who are claiming casual leave should be 30, and 30 and 10 employees should be claiming the sick leave. Compare casual leave 30, sick leave 10. So leave permissible 10 and sick leave 2. So average leave utilized 5. Number of employee 30, number of employee 10. 150 days. Number of 30 days, 150 days and 10 days. So you recognize ability to book insurance 150 into 30. 150 casual leave and employee leave. In a day, 100 employees will be entitled to 10 working days of paid sick leave, which unused sick leave may be carried forward to gradually as leave is taken out of the current year, out of the balance for the previous year before basis. The average annual and 2 days per employee based upon the experience manager expect 1 day, 5 days, Saturday, 3 days to the so average 20. So 100 employees are working. Out of that, they have sick leave is used to days, right? Days and 5 lakhs or 20% of the place it. 1 day is average 50,000. These are limited to 350 employees. Average staff attrition rates observed in past 10 years 6% per annum. I say provide the following benefit: paid vacation 10 days regarding the date of hiring. Compensation paid for vacation 100% employee salary, and the unused vacation can carry forward 1 year. 30% unused vacation carry forward of 3 days per employees, average salary 15,000 per day, and accrued expenses on each used vacation is 6 lakhs. During 10 employees took 6 days of vacation. Let's however recognize the liability of the expenses or the benefit as per so number of employees, unused vacancy is 3 days, intended vacancy 10 days, average vacancy in 10 years 9 days, unused vacancy 30 very much 4 days per employee, unused was 94% to 95 income was 10% on 1 day, 71 hours. Non-accumulating paid absentees. There are absentees that do not carry forward the lapse if the current period entitlement is not used fully by the employee. They are not entitled to cash payment for the unused entitlement leave of the entitlement. For example, sick payment to the extent that unused paid entitlement does not increase the future entitlement. The entity shall recognize a non-liability expense until the time of absence becomes the employee's service does not increase the amount with short-term paid absence accumulating, non-accumulating when the absentees occurs. Accumulating when the employees under service that increase their entitlement to pay future paid absences which are carried forward. Investing when the employees are entitled to cash payments for the unutilized entitlement leave entity. Non-vesting when the employees are not entitled to cash payment for the unused unentitled leave. Profit sharing and bonus plan. The expected cost of the profit sharing and bonus plan shall be recognized when and only when the entity has present legal or a constructive obligation to make such payments as a result of the past events. The reliable estimate of the obligation can be made by the entity. present obligation exists when and only if an entity has no realistic alternative but to make the payment in lieu of the profit and bonuses to its employee. Under some of the profit sharing plans, the employees receive a share of the profit only if they remain with the entity for a specific period. Some plans create a constructive obligation as the employee rendering service that increase the amount to be paid if they remain in service until the end of a specific period. The measurement of such constructive obligation reflects a possibility that some employees may leave without receiving the profit share payment. Entity may have no legal obligation to pay the bonus. Nevertheless, in some cases, an entity may have a practice of paying bonuses. In some cases, the entity has a constructive obligation because the entity has no realistic alternative but to pay the bonus. The measurement of the constructive obligation reflects a possibility that some employees may leave without receiving a bonus. Entity can make a reliable estimate of the legal and constructive obligation under the profit sharing and bonus plan when and only when. The legal terms of the plan contains a formula for determining the amount of the benefit. The entity determines the amount to be paid before the financial statements are approved or issued. This practice gives a clear evidence of the amount of the entity constructive obligation. The obligation under the profit sharing or bonus plan resulting in the employee service or not from transaction with the entity owing bonus. Hence, the entity recognizes the cost of profit sharing. Bonus plans are not to be distribution of the profits but the expenses. The next one is the profit making entity has a reported profit of 200 crores in a financial year. It is distributed annually and pay 5% of the portion of the profit to the employee for 1 year to the operation. Under this plan, entity is under the obligation to pay the employee a compensation a specific pay without obligation. Next is estimate that due to the staff turnover in the organization, estimate payout will be 4.5%. Compute liability of expenses. So 4.5% of 200 crores is 200 crores of profit is 9 crores. It is financial. Acer has 350 employees. Average staff trained rates of observed during 10 years. 10 years represent 6% per annum. The Acer provides the following bonus during past 10 years. Acer has paid all the employees who were serving during the entire financial year. Bonus is paid in June following the financial year end. The amount of bonus of financial year in June is 1,20,000 per employee. Acer Limited used to increase the amount of bonus based on the official inflation rate of 8.5%. Though there is no legal obligation to increase the bonus of such inflation rate. Even how much the Acer recognizes the liability of expenses of the employee. So out of the 350 total number of employees, 350% of 6%. Staff attrition. So 350 into 100 minus 6, it is 94% is 329. What is the per price? 1,20,000 per increase rate of inflation 6%. So 1,35,000. So 329 into 1,35,000 is 4,46,000 to 46 lakhs 20,615. It is employee benefit expenses account to provision of bonus. 46 lakhs 20,625. Note in the given that the company is under the no legal obligation to increase the bonus by the official inflation rate. However, the company has an increase in the bonus by the inflation rate over the past years. This has given rise to a constructive obligation of the Asia Limited. The informal practices such as these cases give rise to constructive obligation where the entity has no realistic alternative but to pay the employee benefit according to the provision made by the amount consideration inflation rate. If the profit sharing and the profit payment bonus are not settled wholly before the 12 months after the end of the reporting period in which employer rendered the related service, those payments are considered as after long-term employee benefits. Disclosure. The standard does not require specific disclosure about short-term employee benefits. However, other NDAs are required disclosure. For example, Ind As 24 requires disclosure about employees' benefit for key managerial person. Ind As 1 presentation of financial statement requires disclosure of employee benefit expenses. Short-term employee benefits. Disclosure as per AS 119, no specific disclosure required, and other AS disclosure should be required as per AS 1 and Ind As 24. Recognition and measurement. As a liability, expenses after reduction amount of paid. If an asset, If amount is paid in excess, the undisclosed amount will benefit the period. As expense, the formal part of cost of asset. Both everything can be short-term paid absences types. Accumulating, non-accumulating. If accumulating, vesting, non-vesting, obligation is recognized on the additional amount. Non-accumulating, no liability and expenditure. No expenditure recognized until the time of absence. Profit sharing and bonuses. Conditions. Entity has a present legal or constructive obligation to pay as a result of the past event. Reliable estimate of the obligation can be made. Recognition of as an expenses and not on the distribution of profit. Post-employment benefits. The post-employment benefits include retirement benefits, such pensions and lump sum payments on retirement. Other post-employment benefits such as post-employment life insurance and post-employment medical care. Depending upon the economic substance of the plan, which is derived from the principal terms and conditions, the post-employment benefits are classified into either defined contribution plans or defined benefit plans. Post-employment basis, defined contribution plan, defined benefit plan. Retirement benefits such as pensions and lump sum payments or retirement. Others some post-employment benefits such as post-employment life insurance and post-employment medical care. The classification of post-employment benefit plans into different contribution plans or defined contribution plan, defined benefit plan. Under the defined contribution plan, the entity legal or constructive obligations are limited to this amount that is agreed to the contributor of the fund. Thus, the amount of the post-employment benefits recovered by the employee is determined by the amount of contribution paid by the entity, and perhaps also the employee to the post-employment benefit plan or to the insurance company, together with the investment returns arising from the contribution. As a result of its actual risk, which means a benefit which to be less than expected, and investment risk, then the assets invested will be insufficient to meet the expected benefits. Also, the substance of the employees and not on the entities like in defined benefit plan. Exemption. In certain cases, the entity obligation is not limited to the amount that is agreed contribution to the fund as the entity has legal constructive obligation. Example of such is a plan benefit formula that is not linked solely to the amount of contribution requires the entity to provide further contribution if assets are insufficient to make the benefit of plan and benefit formula. A guarantee either directly or through a plan or indirectly a specific return on contribution. Informal practice that gives rise to constructive obligation. For example, the construction obligation may be arise when an entity has a history of increasing benefits of former employees to keep pace with inflation, even though there is no legal obligation to do so. Under defined benefit plans, entity obligation is to provide an agreed benefit to the current and former employees and auxiliary risk. The benefit will cost more than expected and investment risk for the substance of the entity and not on the employees like case of defined contribution. This is an auxiliary investment expenditure worse than expected the entity's obligation. The above difference can be summarized as follows. Particulars. Entity obligation, defined contribution plan. The entity's legal constructive obligation is limited to the amount that is agreed to contribute to the fund. Defined benefit plan. The entity's obligation is to provide the agreed benefit to the current and former employees. Risk bearer. In the defined contribution plan, auxiliary risk and investment risk falls on the employee, not on the entity. Defined benefit plans. The auxiliary risk and investment risk falls on the entity, it's not on the employee. Change in the obligation. The defined contribution plan. Generally, no change in the contribution of the entity is made except in certain cases. In change in the obligation, in defined benefit plan, the auxiliaries or investment experience are worse than the expected. Entity obligation may be increased for providing to the employee. Determination of the amount of post-employment benefit. Defined contribution plan. The amount of the post-employment benefits recovered by the employee is determined by the amount of contribution paid by the entity and the employee as well as. In the case of defined benefit plan, the predetermined and agreed post-employment benefits are received by the employee. Illustration 9. The company pays each employee a lump sum of one-time benefit for retirement. The benefit contributed based on the employee's years in service in the company and the final salary prior to the payment. They cover the liability of the remuneration company percentage plan gross company pay contribution to the fund, it covers liability. The amount remuneration is determined in advance, and the company will have to carry the risk in the case the fund assets are not sufficient to cover the remuneration in full. Accordance with the applicable legislation, the company contributes 12% or employees 12% of the annual gross salary to the provident pension fund. Over time, when the employee will get the accumulated balances, it is calculated based on the employee's year of service and this average salary of past 15 years before retirement. The pension will be paid out of the state fund assets, and the company has no further obligation except to make contribution. Analyze whether the obligation present defined contribution plan or defined benefit plan. Is a defined contribution plan. Although the employee pension is determined in advance by the formula, and the employee neither carry actuaries nor investment risk, company liability to limited is limited to the contribution to the fund. In this case, the pension will be paid out of the state fund. It's a state fund which carries all the risk. Multi-employer plans. The entity shall classify a multi-employer plan, define the contribution plan, and define benefit plan under the terms of the plan, including any contribution obligation that goes beyond the formula terms. In the case of multi-employer definition plan, normally the amount of contribution is decided and keep in mind the amount of benefit that the entity is required to pay in the same period, and the future benefits the entities go gets during the current period will be paid out of the future contribution. The employer have no realistic means of withdrawing from the plan without paying contribution for the benefit. Employees' benefit are determined by the length of the service in the entity as a future amount is required to be paid to them. Such a plan which creates an actual risk to the entity. If an ultimate cost of benefit already earned at the end of the reporting period is more than expected, the entity will have to either increase its contribution or to persuade the employee to accept the reduction. In the case of multi-employer plan is defined benefit plan, entity shall account for the proportionate share of it. Define the benefit obligation, plan the assets, cost associated with the plan the same way as far as any other defined benefit plan, and disclose the information required. When the sufficient information is not available, they use defined benefit accounting for a multiple employer plan, that is defined benefit plan, and entity shall account for the plan as it were defined contribution plan. Disclosure. The fact that the plan is defined the benefit plan. The reason why sufficient information is not available to enable the entity to account for the plan as a defined benefit plan and the expected contribution to the plan for the next annual reporting period. To the extent the surplus and deficit of the plan may affect the amount of future contribution, the available information about the surplus or deficit, the basis used to determine the surplus or deficit, and the implication, if any, for the entity. The reason that the entity is not able to term the plan as defined benefit plan as to how the account for plan for multi-employer benefits contributions may occur to. The entity does not have access to the sufficient information but the plan to satisfy the requirement of the standard. The plan exposes the entity to auxiliary risk associated with the current and former employees and other entities. With the result, there is no consistent, reliable basis allocation of obligation, plan assets, and costs of individual entity participate in the plan. There may be a contractual agreement between the multi-employer plan and the participant whereby how the surplus of the plan will be contribution of distributed to the participant as a deficit fund. The participation of multi-employer plan with such an agreement that accounts for the plan and defined contribution plan shall recognize assets or liability that arise from the contractual agreement and resulting in income on expense of programs. Determination when is a combination how to measure liability relating to the winding of multi-employer defined benefit plan. The entity withdraw from the multi-employer defined benefit plan. The entity shall apply indicates the provision, condition, liability, and condition assets. The paras does not have any sufficient information about the defined benefit plan and this account for the plan if it were defined contribution plan. The plan there was a contractual agreement between the paras private limited and the participant to the share of deficit amount. The fund valuation shows a deficit of 500 million in the plan. The plan has agreed under the contract and scheduled contribution with the participation employees plan that is eliminate the Over the next 10 years, the entity's total contribution was 30 million. As per India's parallel should recognize a liability in the contribution adjusted for the time value of money and equal expenditure. Group administration plans. Group administration plans. And the group administration plan is merely an aggregation of a single employer plan combined with the allow participating employers to pool their assets for investment purpose and reduce the investment management and administrative costs. The claims of the different employees are segregated for the sole benefits of their own employees. In other words, individual identities of the employees and the entities are preserved. Unless it's a case of multi-employer plans wherein the identity of the employees and the entities are lost in the common pool. The the group administration plan poses no particular accounting problem because information is readily available to treat them the same way as the other single employer plan. This is because such plans do not expose the participating entities to actual risk associated with the current and former employees of other entities. An entity should classify a group of administrative plan as defined combination plan or the defined benefit plan in accordance with the terms of the plan, including any constructive obligation that goes beyond the formal terms. The definition defined benefit plans that shares the risk between entities under the common pool. Defined benefit entities define benefit plans that the share risk between the entities under the common control. For example, parent and their subsidiaries are not multi-employer plans. An entity who is participating in such a plan should obtain information about the plan as a whole on the basis of the assumption that it implies to the plan as a whole. An entity shall, in its separate or at individual financial statement, recognize the net defined benefit cost is charged. If there is a contractual agreement or stated policy for charging a net defined benefit cost for the whole plan to individual group entities, in the case there is no such agreement or policies, the net defined benefit cost shall be recognized in the separate or individual financial statement of the group entity. It is legally the sponsoring employer of the plan. The other group entity shall, in the separate or individual financial statement, recognize a cost equal to the contribution payable for the period. A participation in such kind of plan is a related party transaction for each individual group of entity. Therefore, the following disclosure are required by the entity in the separate or individual financial statement: the contractual agreement or a stated policy according to which net defined benefit cost has been charged by the individual entity, or the fact there is no such policy. The policy for defining the contribution by the payer contribute to be paid by the entity. If the entity accounts for the allocation of the net defined benefit cost, then the disclosure shall has to be made for information about the whole plan. If the entity accounts for the contribution payable for the period, the information about the plan is also needed to be disclosed as the plan as the whole. State plans. The state plan is accounted for the same way as a multi-employer plan. The state plan is normally established by legislation to cover all entities. All the entities in the particular category, for example, specific industry, or and are operated by the national or a local government or by the body government, another body. Example, anonymous agencies carried specifically for this purpose, which is not subject to control or influence by the reported entity. Some plans established by the entity providing both compulsory benefits as a substitute for the benefit that would otherwise be covered under the state plan. Additional voluntary benefits. Such plans are not state plans. The state plans are characterized as the defined benefits or a defined contribution. Benefits on the entity's obligation under the plan. Many state plans are funded on pay as you go basis, which implies that contributions are set a level that is expected to be sufficient to pay the required benefit plan falling in the same period. In the kind of this case, the future benefits earned during the current period with the paid out of future contribution. In the most of the state plans, the entity has no legal or constructive obligation to pay those future benefits, as it's the only obligation as the entity to pay the contribution as they fall due. In the case of entity does not employ members of the state plan, it will have no obligation to pay the benefit carried by its own employees in the previous year. For this reason, the state plans are normal defined contribution plans. Insured benefits. The entity normally pays insurance premium for the funded post-employment benefit plan. Entity shall treat such plans as defined contribution plan. Entity shall treat the plan as defined benefit plan in the case of entity has either directly or indirectly the plan. Retain the legal constructive obligation either to pay the employee's benefit directly when they fall due, or further amount if the insured does not pay all the future employee benefit which is related to the employee service in the current and prior periods. But the entity is funded a post-employment benefit obligation and contributes to an insurance policy under which the entity retains a legal constructive obligation. In this case, the payment of the premium does not amount to the defined contribution arrangement. It is either directly or indirectly through the plan. So the mechanism of setting future premium or through a related party arrangement is with the insurer. Hence, the entity shall account for qualification of insurance policy as an plan asset and recognize other insurance policy as an reimbursement right. The entity has no obligation to pay the benefit to the employee, and the insurer has a sole responsibility for paying the benefits. And the insurance policy is in the name of the specific plan participate or a group of plan participates, and the entity does not have any legal contractual obligation to cover any loss on the policy. Payment of fixed premium under such kind of arrangement is a settler of the employee benefit obligation rather than the investment to meet the obligation. Therefore, entity treats such payments as a contribution to defined contribution plan. Accounting for defined contribution plan. The reporting entity obligation for said period is determined by the amounts to the contribution by the period. No actuary assumptions are required to measure the obligation or the expense. There is no possibility for any actuary gain or loss. The obligations are measured on an undiscounted basis. Exemption. The discounting is done when the obligation fall due after 12 months after the end of the annual reporting period in which employee rendered the related service. Recognition and measurement. When the employee has rendered service to the entity during the period, the entity shall recognize the contribution payable to the defined contribution plan in exchange of the service as a liability after reduction any contribution already paid. In the case of amount of contribution already paid under the contribution already paid under the defined contribution plan excess the contribution due to the service before the end of the reporting period, the entity shall recognize the excess as an asset to the extent that the repayment will be laid to reduce the future payment or a cash refund. As expenses, it will, if not, include in the cost of the asset as per other Ind As. Example, according to Ind As 2 and as Ind and AS 16. When the contribution is defined, contribution plans do not fall due wholly before 12 months in after the end of the annual reporting period in which employer entered the related service. The contribution shall be discounted using the discount rate in a specified of a standard. Disclosure. The entity shall disclose the amount recognized as expenses for the defined contribution plans. The entity shall disclose the information about contribution to defined contribution plan for the key management person where required under Ind AS 24. Acer Limited provides a lump sum remuneration about it upon retirement of its employee. Remuneration is paid out of the fund which Acer contributes 12% annual gross salaries. The contributions are made twice a year, the November in related financial year and the June after the financial year. Total annual gross salary is 50 crores for the financial year. The contribution made by the Acer November 20 was 2.8 crores. Remuneration depending on the number of employee services and the amount of cash in the fund of the retired date and no further obligation expect the contribution. How much the transaction appears in the financial year Acer of the 31st March. So 50 crores, 12%, 6 crores. What is made is 3.2 crores accrued. The accounting treatment is bank 2. Employee benefit expenses 6 crores out of his bank account is 2.8 crores. Contributed payable is 3.2 crores. The contribution of 6 crores will be debited in the statement of profit and loss account. The contribution payable is 3.2 crores will appear as a liability on 31st March. Accounting for defined benefit plans. Accounting for defined benefit plans is a complex because accrual assumptions are required to measure the obligations and the expenses. There is a possibility of actual gains and actual loss. The obligations are measured on the discounted basis because they may be settled many years after the employee surrendered the added service. Thinker Limited, a large IT company, accounts for the gratuity on the payment basis. Supports such accounting policy for making the following disclosure in the financial statement. Due to high labor turnover, the large degree of uncertainty is involved in estimating the liability of gratuity. According to the management, opinions that the estimation of the uncertainty would confuse the readers of the compliance of the financial statement. The liability will be recorded on the payment basis. Management opinizes that making the above disclosure company is completely required under Ind AS. Disclosure to the effect of the above is to given. The management is also willing to specifically highlight the above aspect to making it conspicuous in the financial statement. The content of management's right as per the Ind AS, the gratuity payment is payment has been made to the employee upon retirement resignation from the organization. The amount is determined in accordance with the provision of Gratuity Act 1972, which applies to Thinker Limited. Since the amount is determined pursuant to the formula laid down under the statute, the gratuity payable represent a defined benefit plan that is to be paid to the employees with the actuary risk and investment risk both belongs to the employer. Thus, Thinker Limited may comply with the Ind AS 19 and provide the gratuity on an annual basis. In estimating the liability of gratuity, there would be several assumptions involved, such as mortality rate, staff attrition rate, salary at the time of retirement, salary at the time of resignation, discount rate, etc. All of which have to be considered by Thinker Limited. The complexity involved in excising does not provide Thinker Limited the excuse to avoid the accrual accounting. Thinker Limited as a state it would be willing to make the disclosure to the effect of a departure from Ind AS requirement. The terms of para 19 of Ind AS 1, departure is permitted to extreme rare circumstances wherein the management concludes that the compliance with the Ind AS required would be so misleading that it would conflict with the objective of financial statements set out in the framework. In the given case, compliance with Ind AS would not be conflict, as a compliance with Ind AS 19 would ensure that accrual assumption laid down in the framework is complied with. Further, the disclosure would not be removed or cannot be a remedy for non-compliance. Therefore, the company has to state that Ind AS have not been complied by the company in preparation presentation of financial statement. Hence, the company will have to suitably modify the financial statements, consider the materiality and perseverance of the non-compliance. Recognition and measurement. The defined benefit plan can be unfunded or wholly or partly funded by a contribution by the entity, sometimes by its employee, into an entity or a fund which is legally separate from the reporting entity or from which the employee's benefits are paid. The payment of the fund's benefit when they are fully due depends on financial positions and investment performance of the fund. The entity's ability to and willingness to make the good and any shortfalls in the fund assets. Therefore, the entity is in substitute underwrites the actuary investment risk associated with the plan. Hence, the expenses recognized for the defined benefit plan is not necessary and the amount of contribution due for the period.